Good morning, site members, and welcome to the fourth morning here at our 2021 Investment Infrastructure Expo. My name is Jeremy Bennett. I am Site's Executive Director, and I welcome everybody to our presentations today. So we have a pretty cool theme going on here, and I think everyone's pretty interested on what these economic outlook and conditions look like for our economy and also for specifically the construction industry. So we're going to dive into that today. We're also going to be talking about how COVID has impacted some of the revenue streams for some of the municipalities here in the St. Louis area. So we're happy to have the Federal Reserve Bank and the Metro Municipal League with us today, and we'll get into that just a little bit. So with that, I'd like to thank our presenting sponsor today, Fabic Cat. You'll see a nice video message from them, but also our expo sponsors, and we couldn't do it without all our sponsors. So Advanced Drainage Systems, ASP Enterprises, Bus and Quarries, Central Power Systems and Services, CMW Equipment, Energy Petroleum and Marketing, Fixed Supply Service, KJ Undersaw Construction, MBUS Contracting, Pace Construction Company, Pat Kelly Equipment Company, Purple Wave Auction, Roland Machinery Company, Rush Truck Centers of Missouri, Thomas Industrial Coatings, Traymar Contracting, 2 Alpha Contracting, and United Rentals. So thank you again to all of our sponsors. Today on the agenda, talk about the format just a little bit. We have the Federal Reserve Bank. We have Kevin Kleeson, who is the business economist and research officer with us. And he is no stranger to our program. He's been with us a number of times for our expo. So thank you, Kevin, for joining us. We will have a break right at 10:10, and then we will bring on Pat Kelly, who is the executive director of the Municipal League of Metropolitan St. Louis. So with that, if you have any questions, there will be a chat feature at the bottom of your screen. You can comment. Also, if you'd like to look at the past presentations from Site, you can click on the QR code, take a picture of it. It'll take you right to our website, or visit Site's website at sitestl.org. And now what I'd like to do is have a quick message from our presenting sponsor, Fabic Cat.
In these challenging, uncertain, uncharted times, you stand strong. No matter the conditions you face, you get the job done. You are the backbone of our communities. You are the hardworking men and women that continue to build. We're honored to call you our customers and our employees. We thank you for the work you've done and the work you continue to do. Together, we'll get through this.
All right, and thank you to Fabic Cat for your presenting sponsorship. At this time, I'd like to welcome Kevin Kleeson into the live stream. Good morning, Kevin. How are you?
Good morning, Jeremy.
I'm sorry for butchering your title there. Didn't mean to do that. But it's interesting. A lot of our members are curious about what this economic outlook is going to look like, and then also how it's forecasted for the construction industry specifically. With a new administration and some vaccine dynamics, I'm sure that it's going to present a pretty challenging outlook.
Yep, fun never ends for me.
Well, thank you again for joining us. I know that you've been to our expo a number of times and have done a number of presentations. So with that, we'll go ahead and get right to it.
Okay, sounds good. Let's see. I don't see my presentation. There we go. Oh. Can you see it?
It looks good.
Okay, good. Well, thank you again, Jeremy. And so I'm going to kind of walk through my what I think is kind of the key developments in the economy and kind of the stress points and where I see the U.S. economy going over the next year or two. So as always, these views are my own and not necessarily those of the Federal Reserve Bank of St. Louis or the Federal Reserve System. So, I always like to start my talks by kind of giving the 30,000-foot view. It's very easy to sort of get lost in the sort of this world where the information flow is just relentless and unceasing. So we've had two what economists call global shocks over the past dozen years: the financial crisis and now the pandemic. As Jeremy mentioned, we're kind of shifting away what I call pandemic dynamics. So this is the idea of states imposing containment measures and people being fearful of going out to eat or travel, to now we're transitioning to a period what I call vaccine dynamics, where containment measures are being reduced and people are more comfortable going out and traveling. So that shift is underway. The speed of the shift started slowly, but it appears to be picking up as the vaccine doses ramp up. There's a new administration, obviously, with very different economic policies, and we kind of see that with some of the proposals being put forward. So that will, at some level, obviously affect the economy going forward. And I think just to prelude my point, most forecasters, including myself, expect much stronger economic conditions this year, next year. There is, though, some risk of much higher inflation. So let me talk about kind of the big picture in pictures. So I'm going to show you some slides from our FRED database. If you're not familiar with FRED is Federal Reserve Economic Data. It's a database hosted at the St. Louis Fed. It's the world's largest free database, so it's priced correctly. So this is the broadest measure of economic activity, real GDP, or real gross domestic product. You can see that the decline in real GDP from the peak at the end of 2019 was just stunning. Never seen a decline like that in history. If you look at the table at the right, the decline in the second quarter was a little over 31% at an annual rate. And it's important to know these are annualized rates, so it's kind of like an annual percentage rate of an interest rate that you would be charged for a loan or that you might get for a savings deposit. So if you look at the quarterly rate, which is just simple, the quarter-to-quarter percent change, so minus 31.4% translates into minus 9%. Again, that's a very, very big decline. The economy rebounded sharply in the third quarter and continued to grow in the fourth quarter, but a much slower rate, a little over 4%. I think 5% growth is or probably even stronger is going to be something we'll see in the first quarter of this year. And the early data look pretty promising. So obviously, employment is affected tremendously by the sales of goods and services. So we saw that non-farm payroll employment fell sharply once the pandemic started. It's bounced back a little bit. You can see for the red circles there that basically the decline in the pandemic wiped out almost 10 years of job gains. So again, just stunning. There was a decline in December, bounced back a little bit in January, but still employment's still about 9.8 million below the peak. So it's going to take a while to get back to where we were before the start of the pandemic. Obviously, if employment's falling, that means the unemployment is rising. And we saw the unemployment rate peak in April at a little less than 15%. The Bureau of Labor Statistics, which puts out this series, said that if people had answered the survey correctly, and the unemployment rate is based on a survey of a little over 50,000 households, if people had answered the survey correctly, the true unemployment rate in April probably would have been closer to 20%. The unemployment's come back down, 6.3% in January, but if you measure the total number of people that are still receiving some form of unemployment insurance benefit, That's a little over 11% of the labor force. So the labor market is still impaired, and it's just going to take a while for it to return to something approaching normal. I think a better measure of the labor market is the employment to population ratio. And again, this is just what it sounds. It's the percentage of the population that is employed. And we're currently at about 57.5%. That's well below the peak, but again, also well below the all-time high of the series, which occurred in early 2000. So again, we have a much smaller percentage of the population working, and some of that is due to demographics as the baby boomers begin to retire. Let me look at St. Louis for a second. So this is the St. Louis metropolitan employment picture. So again, very sharp decline, but you can see that whereas the U.S. Decline in payroll employment wiped out about 10 years worth of job gains, the pandemic effectively wiped out nearly 25 years of job gains in St. Louis. So the hole for St. Louis is much deeper. So it's probably going to take longer for St. Louis to climb out of this hole than it is for the nation as a whole. If we look at the employment in St. Louis metro area by major industry, so what this chart is showing you, the light blue line is St. Louis and the darker blue line is the U.S. And basically what it's doing is showing you the percentage change in total employment and then in particular industries throughout 2020. So for example, if you look at the upper left chart for total non-farm payrolls at the depth of the pandemic, for U.S., payroll employment was down about 15% from December 2019, where it was only down about 12% for St. Louis. Now, if you look at most of the industries, we've seen stronger growth in St. Louis compared to the nation. I've highlighted the construction sector there. Construction employment in St. Louis eked out a small gain in 2020. If you look at the bottom lower left chart, the leisure and hospitality services, this is where the pandemic really took a toll on the economy. People not going out to eat, not traveling, no hockey games, no baseball games, and the decline in leisure and hospitality was just stunning. Both U.S. and St. Louis falling 22% last year. And then St. Louis had a bigger decline in government employment than did the nation as a whole. Okay, so let me talk a little bit about some construction trends. So now I'm going to return to U.S. Here the data is better and it's more timely than we see for the state and local levels. So this chart is showing you construction payroll employment. So you can see that for both res and non-res, you saw big declines during the pandemic, the shaded area there. In fact, the decline in residential employment in the residential construction industry was steeper than the non-residential industry. Both industries have bounced back, but you can see that employment in residential construction has continued to grow, and it's now surpassed its pre-pandemic level, whereas for non-residential construction employment, it's kind of tapered off a little bit, and it still remains well below its peak. So this now moves from employment to outlays. Again, and this is U.S. So you can see kind of why the diverging trends you saw in the previous chart with res and non-res. And again, there's a housing boom going on, as probably everybody knows. It's a good time to be a home seller. You can see that residential construction outlays have just skyrocketed very strongly nationwide, whereas construction outlays in the non-residential sector have actually continued to decline throughout the pandemic. And that's despite the fact that, the shift to e-commerce has generated just a huge amount of construction in warehouse space. So this has not been enough to pull forward or pull higher non-residential construction. And then the final line is public construction. So this is state and local effectively, and you can see it really hasn't declined. It's kind of stabilized since earlier this year, in contrast to non-residential private. Okay, so this is one reason why we're seeing weakness in non-residential construction, is that offices are still in major cities almost vacant. So this chart is measuring kind of percent occupancy rates for commercial properties in 10 major U.S. cities. And basically, as of early February, about 12% of commercial office properties in these 10 major cities are occupied. So again, there's a lot of work from home. So really, and people are not sure how long this phenomenon is going to last. Is it permanent? Is it semi-permanent? So this has really, I think, put a damper on plans to build new office construction going forward. So let me turn to the public sector. This is state and local. So the top black line is total public construction spending, and it actually has been on an upward trend over the past 6 years or so, since roughly January 2014. Dipped a little bit in the pandemic and the recession recently, but it's come back a little bit. Still remains below the pre-pandemic peak. And then the other two lines show you the two largest categories of public construction outlays, and that's state and local outlays on highway and streets and education. And again, they've seen a modest uptrend over the past several years, maybe more so for education than state and local highways. But again, we haven't seen the significant declines in these two categories that we've seen in maybe some other categories. So another way to slice and dice the data is kind of focusing on those parts of state and local construction that we might think of as being total infrastructure construction. And this is the sum of education, public safety, transportation, highway and street, sewage and waste disposal, and water supply. So obviously the demand at some level for infrastructure spending is dependent on population growth. Obviously infrastructure deteriorates, so it has to be repaired or replaced. So that's also a factor. But what this chart does is puts it in inflation adjusted dollars, and then measured as on a per capita basis. So you can see that there was a very sizable increase from 1995 to just after the 2001 recession, from about $600,000 per person to a little over $1 million per person. Declined during the expansion from 2001 to 2007, then picked up again, reaching an all-time high in 2009 of a little over 1.1 million. Then declined again after the recession of 2007, 2009, the financial crisis. It's since come back up a little bit, but again, it's still nowhere near the peak that we saw in late 2001 and in the middle of 2009. Okay, so this chart is my good friend Ken Simonson. Some of you may know him or know of him. He's the chief economist for the Associated General Contractors of America. And basically, they recently published a survey of their membership, and they're asking them, give us your projection of the net change in the value of projects in a particular industry or sector relative to 2020. So you can see that, and this is a national survey, and you can see there's only 3 areas where the survey, and again, this is a survey, it's not actual dollars being reported, it's just people the people who responded to this, their estimate of the dollar value change in percentage terms from 2020 to 2021. So healthcare, maybe not surprisingly, warehouse, again, e-commerce and water and sewer. Those are the three categories where this survey suggests we'll see higher dollar values of construction projects this year than last year. And then after that, it just declines, and in some cases declines sharply. Retail, lodging, and private office, again, this is the possibility of these permanent or semi-permanent pandemic effects. And then, you get smaller declines in manufacturing and bridge and highway and so on and so forth. Now, they also do a survey for Missouri, and it's a smaller number of participants. So you maybe not want to take these numbers literally, just because it's a smaller survey, so you have more sampling there. But so the numbers for Missouri are in blue, and so warehouse and water and sewer, much stronger gains are expected by AJC members in 2021. Power also 18% expected to be up this year, and then finally manufacturing expected to be up in 2021 in Missouri as well, whereas for the nation expected to decline by 17%. And then after that, you get kind of similar percentages. Again, very large declines in private office, lodging, and retail. So again, the pandemic looks like it's going to have some longer lasting effects for construction in several areas. Okay, so another challenge that many non-residential construction firms are experiencing, as well as residential, if you're in the home building industry, you know that the prices of lumber are just going through the roof. But this chart is showing you two things. It's the dotted line is showing you what's called the bid price for new non-residential building construction. So you can think of this as sort of the value of the construction that's being bid. And basically, it really hasn't changed that much since April 2020. But if you look at the inputs to new non-residential construction, they're rising sharply. So from April to January 2021, based on the Producer Price Index for the series, input prices are up by about 11%. So obviously that's a pretty sizable margin squeeze for many construction firms. So if they can't obviously pass these costs along, then obviously they'll have to take lower profits, or perhaps just not bid as much on more projects, and obviously that tends to slow economic activity as well. Okay, so let me talk about the infrastructure debate that's going on. Obviously this is kind of a perpetual debate. Some believe that with interest rates so low, now is the time to go big or go home because borrowing costs are low. But that's really been true for the past dozen years or so. I think a key problem is that federal finances are deteriorating rapidly. So if you look at, this chart shows you federal tax receipts, outlays, and the surplus deficit since 1994. So each of the series are on a 12-month rolling sum. So any point on the chart is basically the sum of each of these over the current and previous 11 months. So you can see during the pandemic, outlays or expenditures by the government just skyrocketed in over the 12 months ending in January 2021. Outlays totaled $6.9 trillion. Revenues declined. They've come back a little bit, kind of flatlined, about $3.4 trillion. So obviously, with outlays increasing and revenues roughly staying the same, you get a very sizable decline in the deficit. So over the 12 months ending in January 2021, it's about $3.5 trillion. Again, just huge. The CBO, the Congressional Budget Office, came out with projections a couple weeks ago. They see a deficit this year of $2.3 trillion, and that obviously does not include any sort of subsequent legislation that the administration may be able to get through Congress. So it looks like the deficit this year is going to be much higher than 2.3 trillion. If you look at the debt to GDP, expected to be 100%. So roughly, the debt is going to be the same size of the economy this year, or excuse me, last year, and this year expect to be a little bit larger than the overall size of the economy, about 102%. Okay, so one of the problems nationwide, obviously, you have mandatory spending of Social Security, Medicare, and Medicaid, and that's kind of beginning to really crowd out other forms of spending like infrastructure and defense and education. And we kind of see to that at the state level. So this chart is showing you state expenditures for Medicaid and education. The left chart is showing you all U.S. states. So again, education has been declining since 1990 as a share of total expenditures, whereas Medicaid is basically doubled over this time for all 50 states. It's actually situations even starkly different for Missouri. In 1990, expenditures in Missouri for Medicaid were about 14% of all expenditures. Now it's about 38%. So a near tripling. And again, education, as we see for the nation, education expenditures have also declined as well. So again, these entitlements are really beginning to have a significant and profound effect on other forms of spending going forward. And obviously, since infrastructure is part of the discretionary part of budgeting, that is, the appropriations have to be approved each year, or in case of transportation surface acts, maybe every 5 years. This means that there's a scarce dollars that other forms of private industry are competing for at the state and federal level. Okay, so let me just take a look at the economic outlook from my standpoint. I think the first thing we need to remember is uncertainty is very high. As this chart shows you, this is a measure of economic policy uncertainty put together by some academics at University of Chicago and Stanford University. And you can see that uncertainty just skyrocketed during the pandemic. And obviously, I've done some academic work in this area. And basically, when uncertainty is high, it really just causes firms to, suspend a lot of their activity. There's, it causes them not to hire people, not to go out and spend money on capital projects, because they can't really estimate the rate of return of what an additional employee might add, or a piece of equipment might add to the business. So they just kind of wait for the smoke to clear, for uncertainty to decline before really beginning to make solid plans for spending and hiring going forward. So uncertainty is coming down, but again, it remains extremely high from an historical perspective. Financial conditions, though, look really good. This is the St. Louis Fed's Financial Stress Index. So basically, during times when there's a lot of financial upheaval, like we saw in the global financial crisis there in the middle of the chart, this index rises sharply, and that tends to have a depressing effect not only on stock prices, but also on the overall economy as well. We saw the same thing during the pandemic. Financial conditions deteriorated sharply, but now they've come back down dramatically. I think helped along by some of the policies put in place by the Federal Reserve and some of the legislation passed by Congress, like the CARES Act. So all of that has helped financial market conditions kind of be back to normal. And this chart is designed such that anything below zero is kind of a below average level of financial stress. So again, if you follow the stock market, obviously you know that stock prices have been setting new highs recently. Okay, inflation means below 2%, and that's kind of the Fed instituted inflation 2% inflation target in 2012, and inflation by and large since then has been below 2%. Chair Powell and other senior Federal Reserve officials have basically said, look, we have a 2% target. We need to try to meet that target. And if we don't, maybe that diminishes the credibility of the Federal Reserve. So they've enacted a new strategy or framework to try to meet that 2% inflation target going forward. But with inflation low, the Fed has basically said that as we stand now, based on the data and our forecast, the Fed's interest rate policy target is going to be basically near zero for the next roughly 3 years. So markets really don't expect, nor do Federal Reserve policymakers expect, to be raising their interest rate target anytime soon. Now, this chart shows you what private forecasters are predicting. The Fed doesn't predict market interest rates. So the black line is the 10-year yield, the 3-month yield, the Treasury bill yield is a measure of short-term rates. And again, that tends to follow the Fed's interest rate target. So again, expected to be extremely low levels through the next 4 quarters. Interest rates are projected to rise modestly, but again, still remain well below what they were, say, at the end of 2018. Inflation expectations, though, are rising in part because some people believe that the Fed has its foot on the gas and it's really not going to let up on the gas anytime soon. And you combine that with a huge increase in debt that's being issued by Congress, and now the prospect of maybe even more debt going forward. This has really begun to worry some people and expect higher inflation going forward. So that could be one reason why inflation expectations over the next 5 years, which is the red line, have now surpassed 2%, or now are about just under 2.4%. Part of this, though, is oil prices have risen strongly. So inflation expectations tend to react pretty strongly to oil prices. So again, oil prices are moving higher with the expectation of stronger growth going forward this year and next year. And obviously, this is filtered into refined products like diesel and gasoline. So those are retail gas prices, which include taxes, obviously. So the circle there just shows you that the latest retail gasoline and diesel prices are now running ahead of forecasts put out by the U.S. Energy Information Agency. So when their next forecasts come out in the middle of March, I would expect to see these forecasts for gasoline and diesel prices perhaps increase a little bit. Now these prices could come back down. Part of it is a reflection of the fact that the cold snap that affected Texas and parts of Louisiana shuttered a lot of refinery capacity down there. So this could reflect just natural supply constraints. And as these refineries come back line, these prices could come back down. So we'll have to follow that pretty closely. So inflation is currently low, maybe not for very long. The probability, the odds of an inflation impulse seem pretty high to me. I think all the ingredients are there. Some of the price declines that were caused by the pandemic should reverse as the economy strengthens. Prices for lodging, hotel rates, airline fares, things like that plunged during the pandemic. And as the economy recovers, more and more people get vaccinated and begin to travel and go out again, those prices should begin to lift and return to normal. Commodity prices, I mentioned, already surging, and you throw in the fact that money growth is extremely high. You have rising debt and deficits, and again, the Fed is actively striving to run a hot economy to return the labor market to something more normal. I think all of these things can add up to the fact that all the ingredients for higher inflation are there. We'll just have to wait and see, though. There's very strong disinflationary forces globally that have been in play over the past dozen years or so. So I think one of the things Milton Friedman taught us is that, it takes a while. It takes a while for inflation to get going, but once it gets going, it also takes a while for it to reverse. So my narrative is that, obviously the economy's kind of uneven. Some industries are doing well, some others are not. The labor market's still impaired. I think the U.S. economy is resilient, though. It's bounced back years past, and there's no reason why it can't bounce back this time. Monetary and fiscal policy is highly stimulative. So if you think about the effects of the vaccines and the behavior that would probably induce, and also the fact that a lot of households have saved a lot of money. So all of that, I think, and adding in the economic stimulus, I think there's a rational reason why we should be exuberant going forward. And this is my last chart. Obviously, one of the things the forecasters try to do is try to think about some of the potholes that might be out there. Obviously, we've had new variants of the COVID virus, and it could be the case the new vaccines may not be lead to total or immunity. There could be partial immunity. Obviously, you have the strong growth and huge deficits could cause a spike in interest rates and inflation expectations, and that would probably not be good for housing or the stock market. And then finally, an old standby is geopolitical developments. So, pick your least favorite country. So anyway, thank you very much, and look forward to any questions you might have.
Thanks again, Kevin. Yeah, there's no questions in the queue, but I do have a question. That is, it seems like the St. Louis economy, for contractors anyways, it always seems to stay just a little bit steady, even when there's some variances maybe in the U.S. and other places. And what's the reason behind that?
It's a good observation, Jeremy. I don't know the answer to that question. I think, if I were just looking at the data, I would say that kind of surprises me, just simply because labor force growth in St. Louis has been about half of what we see nationwide for the past 10 to 15 years. So, I don't know offhand why that might be the case. I do think, though, if we do see this sort of substantial rebound nationally, that I think obviously that should filter into the U.S. economy as well, particularly if you get some more fiscal support flowing to state and local governments.
Yeah, and it is interesting. I mean, when people talk about how many cranes are in the air in other cities and how there's just an explosion of growth, St. Louis maybe doesn't see that to that extent, but we always stay somewhat steady. And that's kind of the message that we get back from a number of our contractors, which in a down economy, is a good thing if we're staying steady.
Yeah, there's an old biblical proverb that says slow, steady plotting brings prosperity, and hasty speculation brings poverty. So, the slow and steady may not sound sexy, but, at the end of the day, it might be better than the alternatives.
Well, great. Kevin, we appreciate it. Thank you again for your presentation. We look forward to having somebody from the Federal Reserve Bank to present next year at our expo. And if any questions come up from our site members, and maybe you don't have time to ask it today, email those to Lee@SiteSTL, and we will forward those to Kevin and get an answer back to you. So thank you again, Kevin. And as we go into the break, right after the break, we will have a presentation from Pat Kelly. He's with the Municipal League of Metro St. Louis, and he'll talk about how some of those revenue streams with the certain municipalities in St. Louis have been down a little bit. So with that, we'll go to break and see you guys back here in about 5 minutes. Thank you.
In these challenging, uncertain, uncharted times, you stand strong. No matter the conditions you face, you get the job done. You are the backbone of our communities. You are the hardworking men and women that continue to build. We're honored to call you our customers and our employees. We thank you for the work you've done and the work you continue to do. Together, we'll get through this.
Welcome back, site members. This is our last presentation of the morning, and right now I'd like to pull into the live stream the Executive Director of the Municipal League of Metro St. Louis, Pat Kelly. Pat, good morning, sir.
Hey, Jeremy, it's great to be here.
Awesome. So, Pat, I know that there's many site members who work for the municipalities in town, and a lot of them depend on the capital improvement programs that they have for each year. And so, I know with COVID, we were concerned about some of those revenue streams, and I believe you're going to go into that in some of your presentation.
Yeah, exactly. We'll take a look at the impact on our local governments and really the trickle down, because at local government, it really is a trickle down from the state and federal government.
Awesome. Well, we'll go ahead and get to it. Thank you, Pat.
Great. It's great to be here. And I don't know if I like following somebody from the Federal Reserve, but I'm going to do my best and hopefully give you some new information and then try to answer any questions as we move forward. So I'm going to look at kind of the pandemic impact on infrastructure investment at the local level. I'm going to take a look at the federal funding, the Highway Trust Fund, and the stimulus packages that are coming down from the federal government, as well as Missouri future funding. As we're all aware, the first stay-at-home orders, not only in St. Louis County, but throughout the country, really started early to middle of March of last year. The immediate shutdown, because everything was shut down at the same time, the service industries, construction for a very short time, everybody was stay at home. There was a fear, not knowing how long that was going to go on. At the local level, a lot of municipalities were already planning on a 25 to 40% reduction in sales tax, which is really the primary source of revenue for the local municipalities, specifically in St. Louis County. It's interesting to note that the state and local governments represent about 13% of the employment and 9% of the GDP nationally. So if there's a slowdown, or a reduction at the local level, it's really going to impact the overall economy as well. And unlike the federal government, we at the local level, we can't just print more money. So we are dependent on the economic activity within our communities in order to provide those revenues to use for infrastructure projects. Local governments too. I think it's important to understand we are a service industry. We provide services to the residents of our community. And there's certain things that we have to do. We have to provide police. We have to provide fire. We have to provide trash service. And unfortunately, it's those capital improvement projects are the ones that are most flexible. So when there's a concern about an economic downturn or a loss of revenue, the first place they're going to look in order to cut their budgets is really at their capital improvement projects. We did a survey with our municipalities in about middle of May last year to try to get an outlook of where they're going. Across the board, all the municipalities had either stopped or halted most of their capital improvement projects, and we're really looking at curbing them going into the future or into the next year's budget. It was interesting to see the Federal Reserve, where you said that the municipal or government infrastructure projects were kind of stable. And I think that the reason being is that the projects that did move forward, or a lot of the activity we've seen over the past or the end of 2020, were really because those projects were already budgeted for. The money was in place, and so those projects could move forward. But it's really the ones going into the future that I think we're going to be more concerned about, more so at the county and state level. The overall economy is again, the presentation before pointed out, is some outlooks are very good. I think at the end of the day, as I had mentioned, the municipalities were predicting huge losses, but really at the end of 2020, most municipalities in St. Louis County were down about 5%. Which is really about what the state and also county sales tax were down about that level as well. Now, that's not to say some communities in St. Louis County were hit very hard. And I think without using some of their names, but you can look at them, the ones that are really dependent on one shopping center or very limited retail areas, they were impacted the most. And some of them pretty significantly, upwards, even exceeding 40% in revenue. But overall, again, the U.S. economy was down about $150 billion for state and local governments. That was about 5.5%, which is right where the state in St. Louis County is. But the predictions going forward, as I was mentioning, are also going to be down. So in 2021, economists are predicting, actually an increase, again, 167 billion, almost 5.7%. And then even going into 2022, about 145 billion, and then which is about 4.7%. In the state of Missouri, it was actually kind of interesting this year. The incomes were offset by the first stimulus package, the CARES Act. So state sales tax was actually up about 10%. Total revenue was up about 18%, almost a $1 billion increase. At the local level, I think the reason you saw in St. Louis County that the decrease in sales tax revenue wasn't as impactful as everyone had feared is because the industry shifted. So once things started to loosen up, as we saw almost a boom in home investment. Lumber prices, as mentioned before, skyrocketed. People were, new homes. People are buying new homes and investing in their existing homes. So there was a shift in that industry. And even though all the restaurants and service industries were impacted, I think the most, those dollars that weren't being spent at restaurants were being spent at the grocery store. So people were still buying their food, they were just getting it at different places. So it really wasn't as bad as everybody had anticipated. But at the state level, one of the interesting things when you see that the revenues were up 18%, one of the reasons for that was because they extended the deadline for income tax to be filed. And so by doing so, some of the revenues that should have come in from the previous tax year didn't come in until 2020 year for the state of Missouri. So it's really kind of not as good as it seems. It's going to get caught up as we move forward, as revenues decline from that shift. That really is not a good indicator of where the state really is. And the other key factor was the federal funds that were received in the stimulus package. A lot of people don't know, but the first CARES Act package really did not have any funds for local government. And when the act was first initiated, it was only for COVID-related expenses. So really at the local level, that was very limited. In May of last year, the Trump administration loosened the reins on that a little bit and allowed for some reimbursement to local governments for public safety expenses. We worked with St. Louis County, the Municipal League did, and we were able to get $47 million that was distributed to municipalities in St. Louis County on a per capita basis, which really helped offset some of their losses in revenue, but not totally. As many of you know, the St. Louis County is really the economic driver for the state. St. Louis County sales were down, as I mentioned before, right at 5%, 4.9%. What's really interesting about that is retail sales in St. Louis were down at about 11%. And the reason there's a gap between the total sales tax and that retail sales tax level is because a lot of the sales taxes, for instance, Park Stormwater sales tax for St. Louis County isn't collected on pharmaceuticals and food. So there's a big gap between those revenue sources and then retail. So the real impact on the economy for St. Louis as a whole, or on the retail level, I should say, was really at about 11%. And as I mentioned before, municipalities were down about 6% in revenue. I'm going to look a little bit at the Highway Trust Fund. The Highway Trust Fund, finances most the federal spending comes from the Highway Trust Fund. It's kind of interesting that which is again is collected on the fuel tax, the federal fuel tax. Like Missouri, the federal fuel tax hasn't increased since 1993. The stimulus bills include $14 billion in transit agents. This is the proposed package that they were working on and hopefully to roll out if our federal government can come to a consensus. But it's going to be $14 billion for transit agencies, $10 billion for state and highway funding, $2 billion for airport, and $1 billion for Amtrak. That $10 billion in highway funding will be distributed to the states according to the existing appropriation formula. That I think is going to change. That's what they were talking about a month ago. I was hoping, last week they said that President Biden was going to roll out his transportation funding plan this Monday. That didn't happen. In talking to some representatives from MoDOT, they had some meetings earlier this week. And they're hearing now that because of the debate on the current stimulus package and other issues facing our federal government or things that they want to be concerned about, that they probably not going to get to their highway funding formula or package until mid to late summer. The focus is really going to be on infrastructure, but leaning towards green infrastructure as well. How do we, they want to get, charging stations and infrastructure that's going to help support moving into a green, electric cars and so forth. In Missouri, in the local level, 2019, Missouri received about $778 million in state highway funding. $104 million was for cities and counties, and $78 million for safety programs and multimodal grants. MoDOT's annual shortfall, as I'm sure many of you know, is about $745 million. In 2020, MoDOT received $61.7 million from the CARES Act funding. But again, it's still a big shortfall from where they need to be. At the Missouri legislature, looking for sources of funding. Again, I don't think this is anybody new, or this isn't new to anybody that I'm talking to or listening to this presentation, because you're all keen to what the state of Missouri and how they approach new taxes and funding for infrastructure, specifically for highways, roads, and bridges. Looking at some of the legislation this year at the state capitol, there's a number of bills in the House to try to increase funding for highway funding or infrastructure, I should say. I can tell you that spending a lot of time in the Capitol, none of the bills in the House are really going to move anywhere. I don't think even any of these bills have had any hearings to this point. In the Senate, Senator Schatz and working with Lieutenant Governor Keough have really continued to be focused on funding for MoDOT and our infrastructure. And this is being backed by the governor as well. As we all know, we worked very hard. Municipal League did, as well as many of you in this industry, on Prop D a few years ago, when the governor and lieutenant governor stepped up to the plate and really backed that proposal on the ballot. Unfortunately, it didn't pass. So what they're going to try to do this year at the legislature is to try to actually do something within the legislature so that it doesn't have to go to a vote. And so Senate Bill 262, which was presented by Senator Schatz, and now it's Senate Committee Substitute, Senate Bill 262. We had a meeting on Monday at the state capitol, and Lieutenant Governor and Dave Schatz presented where they are and where they hope to go with this. But currently, the bill would be a 2.5% increase in fuel tax for the next 6 years, or for a 6-year period would mean a total increase of 15 cents. It would one of the key components of this legislation is that consumers would have the ability to seek reimbursement for their fuel tax increase, which is kind of a give and take at the state capitol, so that to get some of what I would call the conservative Republicans on board to support this legislation so that we could do it legislatively. That rebate option would then expire in 2028, and then we would have the tax in place. Some of the things that were talked about at the committee meeting on Monday were some of the trucking industries, and so forth. They have concerns about the fact that it's such a high increase. But again, it's phased in over a 6-year period. And then the other concern is, how does the state capture or tax the electric cars? And really, that's going to be a big concern moving forward, and they really want to get it worked out in this legislation. Ford and GM are saying that they're going to have a complete electric car, or actually all of their cars will be electric no later than 2030 and 2035. And right now, there isn't a mechanism, at least in the state of Missouri, in order to collect that fee, like a gas tax, on those electric vehicles, and yet they would still be, using the roads and as the other cars do today. So that's going to be a key component, or something that they need to figure out within this legislation. There are a couple other bills that I thought were interesting. Peter Meredith, he wanted to allow the motor fuel tax to be used for public transportation in schools, which is kind of interesting given we already have such a shortfall. And then Representative Don Roan, the bill changed the percentage by which voters on a local motor fuel tax must pass by 2/3 instead of a simple majority for those jurisdictions that have the ability to impose a local tax. Before we get to questions, I did want to make a couple more comments. The current stimulus package that is on the table at the federal government, if it were to come out today, there would be a direct pass-through to the municipalities for some support. Unfortunately, the way they have it designed right now, in the state of Missouri, there'd be about $2.5 billion just for local governments, for municipal governments. But they're going to base the distribution on development block grant fund allocations. And for those of you that don't know that, these are funds that are allocated through HUD to local municipalities based on need, based on low income areas within your community, and based on being able to use those funds to invest in those low income areas. So for a lot of municipalities in St. Louis County, that's a very limited resource. I can speak specifically to the city of Brentwood. They receive about $20,000 a year in development block grant funds. And the city of Ladue probably doesn't receive any. So those communities probably would not receive any additional funding from this next stimulus package. But a city like St. Louis, the estimate for St. Louis is that they would receive almost $450 million in this stimulus package as a municipality, and then about another $58 million for their county allocation. St. Louis County government would receive about $194 million under the current package, and that these sources of revenue would go into general revenue, which is, again, different from the original CARES Act, which was only those stimulus packages could only be spent on COVID-related expenses. So those would really help the county and obviously the city of St. Louis. Going forward, I still think we're going to see at least some caution as municipalities move forward. They're spending on their capital improvement projects, specifically, roadways and bridges. I think that's going to continue probably for the next 2 years. So with that, I'd be more than happy to try to answer any questions if anybody has any.
All right. Thank you, Pat. Thank you for the presentation. There are no questions in the queue. I think, Pat, one of the questions that, and it's come up a number of different times is, are there municipalities out there that are still holding back projects that went to bid, and will those get released, or are they holding off until there's more funding mechanisms in place? And what are you hearing on that?
Well, again, it's kind of interesting. Some of the cities' revenues are actually up. Because and I used to be the mayor of Brentwood. I'm not gonna, but I'm not just pointing them out. But they have a very diverse retail base, and so their revenues are up. They're doing a major $80 million project that is moving ahead, and will continue over the next few years, which is a huge flood mitigation project. But then other cities, are impacted and they're just holding the reins back. I think overall in St. Louis County, cities are still kind of on a wait and see. They want to make sure that the revenues are going to be in place in order for them to provide those day-to-day services for the for their residents. So, they want to make sure that they're going to be able have the resources to fund their police and fire and trash. And then, once they a little bit more comfortable, I think they'll loosen the reins a little bit and proceed with some of those projects.
Okay, great. Yeah, it's always on the mind of the contractors. They do a lot of work for the municipalities here. A lot of our members do. So good to hear that. And we hope that, there's some consensus on the stimulus bill and that we can get some of these funding mechanisms in place so we can move forward with some capital improvement projects. So thank you again to Pat Kelly. Looking forward to seeing you in the future. And with that, we'll move right into some just closing remarks from site. We are celebrating our 55th anniversary this year. And of course, we want to bring our members back together, and we are doing just that. So on May 12th, we are having our first networking event in over a year. We're bringing people together. We are going to Topgolf from 4:30 to 6:30. We're going to enjoy some cocktails and networking and getting everyone together. And that's going to be $21 a person. And we're limiting that to the first 100 registrants. So Leah mentioned to me that we had already had a number of people register. So please register quickly, and we'll fill up that event hopefully here in May. So with that, I'd also like to thank all the sponsors for today. Our presenting sponsor, Favorite Cat, huge thank you to you. And then also our expo sponsors. We couldn't do it without everyone's sponsorship and participation, and that's Advanced Drainage Systems, ASP Enterprises, Bus and Quarries, Central Power Systems and Services, CMW Equipment, Energy Petroleum and Marketing, Fixed Supply Service, KG Undersall Construction, MB West Contracting, Pace Construction Company, Pat Kelly Equipment Company, Purple Wave Auction, Roland Machinery Company, Rush Truck Centers of Missouri, Thomas Industrial Coatings, Traymar Contracting, 2 Alpha Contracting, United Rentals. So thank you again to all of our expo sponsors. We are getting very close to wrapping up our expo week. Tomorrow, we actually have a project spotlight, and that's going to be the River Point project in St. Charles. For those that don't know, there's 325 acres along the St. Charles riverfront, just on the south side of 70, that is prime for development, and there's already developers in the queue to put some of those projects to work. So we have Brad Tem, who's the Director of Engineering, who's going to give a great presentation. Very interesting for those that visit the St. Charles area. There's going to be a lot of changes coming on the riverfront. With that, if you've missed any of our presentations, or if you'd like to view any of our past presentations, you can go onto our website, sitestl.org. There's a QR code on the screen you can take a picture of, and it'll take you right to the webpage. And with that, I hope that everyone is enjoying their time here at the expo and learning a lot of information. This is my final day hosting this expo presentation. Chris Davis, our Government Affairs Director, will be on tomorrow. I've got some Smith Mason's negotiations that I'm looking forward to sitting down and completing a contract with tomorrow morning. So again, thank you to all of our site members who have participated so far in the expo. Looking forward to one last day with you tomorrow on Friday. Take care and have a great day.